Hello, everybody.
Hey guys.
Welcome to the first live ever at Bravos Research YouTube. Very excited about this, and also great timing. Markets are quite interesting today, to say the least. Bitcoin's very interesting. We're going to dive into stocks. We currently have a short trade on the stock market right now. We're going to talk about the depth of the pullback. The trades that we have on our watch list, our strategy. Lots of potential opportunities on the lookout right now. So very interesting stuff, and also precious metals. We're going to touch on gold and silver that have been very hot, and we're gonna hint at potential opportunity that's coming on silver. So before that, quick introduction. I'm Peter, the founder of Bravos Research, and I'm here with Nick.
Hey guys.
Firstly, Nick, incredible trader with deep technical and macro knowledge. I know he's very humble, so he doesn't like me saying that, but he's a very disciplined, methodical trader, and he has very strong performance in the market. So he's part of the trading team, and he has a trading style that's very similar to my trading style, to the Bravos trading style, incorporating macro, looking at individual stocks, um, prioritizing mindset, prioritizing price action. So very excited to be doing this live together. Um, Before we get into that, we did promise that we would be doing an exclusive offer in this session, an offer that's for Black Friday. Um, every year we do a discount on our service, but this year we want to do something a little bit special, and especially for those of you who are on the live right now, something that's an offer that's only available during this live. So let me just my share my screen so that you guys see the offer right here. So what we're currently working on is a complete Bravos trading system. So a complete trading curriculum of everything we know about trading, how we screen stocks, how we enter, how we exit positions, how we manage trades, how we manage our allocation to stocks, how we manage our allocation to different assets, how we trade in different types of market environments. All of that is going to be included in the trading curriculum. Now we're still building it, right? This is something that's a little bit, it's a pre-order in the sense that we're building it week by week. This is a product that we released for our trading mentorship clients, or our VIP clients that we're building this out for them. But a lot of people have asked us to actually release it separately. So this is going to be a lifetime access to all of the educational content that we're ever going to be producing, as long as Bravos exists. So the lifetime access to that. Let me show you the original pricing of this. It's going to be priced at $4,800 without the discount. But with this bundle, you also have an access to a year of the Bravos trading signal. So all of our trades, our entries, our exits, and the breakdowns of how we're thinking about the market, how we're thinking about each trade, and basically everything that we're doing behind the scenes. Value of that, $1,800 a year. And then finally, a year also of weekly training sessions, educational sessions with live coaching with Nick and myself, addressing the most important points of trading and how to actually build your skill in the market. This is not, by the way, something that we're presenting as a way to get rich overnight, right? This is something that's designed to build the skill to trade the market properly, to trade the market like a pro. And if you figure out how to build yourself into a successful trader, if you figure out how to have discipline have the right mindset when it comes to trading, and understand how markets actually work, that sets you on a path to build true wealth through the market. That's the only way to approach trading. So that's what we're providing here. Everything that you need for a 60% discount on all of this, right? So we'll do a Q&A session at the very end of the live to address any questions that you guys might have on this. We'll be joined by my co-founder. He's going to help answer any queries that you guys may have on this. So the link is in the description down below. So if you want to take advantage of the offer, as long as the live is live, as long as we're live, the offer is going to be available. So after the live, we're going to take it off, and we're still going to provide this, but the discount is not going to be 60%, which is absolutely crazy, of course. So let's dive into the live. Let me share my stop sharing my screen and move to the market. All right. So as I mentioned at the beginning of this video, we're going to talk about the stock market. We're going to talk about Bitcoin and gold. But the title of this live is that stocks are breaking down. And before we address that breakdown that you can see right here, I think it's important to zoom out and highlight the context of this rally. This has been, from the low, a 40% rally. This is one of the strongest rallies, and this is something we've talked about in YouTube videos, the strongest rallies since 2020. And zooming out more than that, this is something that we've really only seen throughout history. We've really only seen at the very beginning of major bull markets in stocks, right? So 2020, 2009, 2003, 1990, 1980, right? And that's what we saw here, right? So there is something, right? And this is going to be a core point throughout this live, throughout our curriculum. This is something that we stress on so much, is the importance of price. It's listen to what price is telling you. When there is such strong behavior in the market, such strong technicals, right? Price action, technical analysis. That's the market telling you that there's something happening underneath the surface. Now let's dive in a little bit. Put on key moving averages. You can see key moving averages are pointing upwards. We are in a very, very strong trend on the S&P 500 right now. That's a representation of an extremely strong macro environment. Now, you can be bearish on the economy, bearish. Obviously, consumer sentiment is down the drain. There's political polarity. There's shelter costs through the roof. Personal savings rate are down. So there's lots of things wrong with the economy. But one thing that's working today is corporate America, right? And so corporations in the US are thriving, especially tech corporations, especially mega tech corporations. And so they are able to grow their earnings, grow their profit margins. And we have an economy with relatively resilient growth. We have the Fed that's cutting interest rates with inflation coming down. And all of that is providing a bullish macro tailwind to stocks, at least for now. We're going to talk about in just a second the risks to that. But yes, that's essentially what the technicals are representing. And there's no reason, at least for now, to really be fighting that. Now, let's zoom in and understand what is happening here on this recent breakdown. For some context, one of the things that we've been paying attention to with our members at Bravos Research is the breadth of the market, the internal structure of the market. You can see here, this is an indicator called the percentage of stocks above their 50-day moving average in blue here. So this is showing us how many stocks in the S&P 500, right? Because the S&P is a basket of stocks. It's there's stocks participating to the price action, and it tells us how many stocks within the index are actually moving up above their 50-day moving average. For context, This is the 50-day moving average on the S&P 500. And since late July, we've had a huge deterioration in the breadth of the market. So as the index has actually climbed higher, the breadth has declined. And at multiple points in October, we had the breadth of the market actually be below 50%. So less than 50% of stocks were trading up in the market, while the index was climbing higher and making higher highs. So, we had strong evidence, strong enough evidence for us to really start getting more defensive. This is something, by the way, that happened heading into the 2025 top, the February 2025 top, a big weakness in the breadth of the market. So that prompted us in October to start getting defensive. We've been getting defensive here. And now more recently, we're even starting to see a little bit of a breakdown. But here I want to let Nick press on a little bit of a point here.
Yeah, so just to add a little bit of color to what Peter is saying here, this is exactly why our approach has always been to stay focused on the sectors that are showing the strongest relative strength.
Yeah.
So since the April lows, the leadership has been really clear. It's been gold, it's been tech and semiconductors, and those have been the sectors that have really been driving the market higher. So naturally, a lot of our trades within that time frame had been concentrated in those areas, and that's a huge part of the Bravos playbook. Is we follow the strength until the strength changes. Now, over the last few weeks, we've started to see some rotation out of those leaders, not necessarily a collapse, not a long-term breakdown, but definitely a short-term cooling off. And at the same time, we've been seeing money rotate into some more defensive pockets. In particular, we're seeing healthcare and health tech start to make some really big moves. And that's exactly why since late September, we started scaling into a few names in that space. And we've continued to add a few more as that trend has continued to build momentum. So with that being said, it doesn't mean that we're necessarily done with trading in tech or trading in semis. I mean, if momentum comes back and if those sectors reclaim their leadership and the relative strength returns, we're absolutely looking for more setups in those areas again, because the longer term macro narrative hasn't really changed yet. So right now we're being patient, and we want the market to repair some of the underlying weakness that Peter was just talking about, with weaker breadth and your rising VIX and your defensive behavior. And once that stabilizes, that's when we can start pressing our risk again.
Yeah, absolutely. And by the way, this is the tech sector chart, XLK. And yeah, absolutely. It's been the strongest performing, one of the strongest performing sectors since the April low, and just very typical price action. The strongest parts of the market on the way up are the weakest parts of the market on the way down. Now, coming out of this correction, and we're going to highlight why we think this is going to be a shallow correction. At least this one is going to be a shallow correction. Coming out of this correction, we want to be exposed to tech again if we see setups unfold. So again, we're going to come back to that in just a second. But for now, as of now, what is the price telling us? Right, we're seeing the S&P 500 breaking below a key price channel here. You can see this is a price channel that's been intact really since mid-July, that it's been trading in. And just here earlier this week, actually, we had just enough evidence to initiate a short bet on the S&P 500 that we currently actually have right now. One of the reasons for that, and this is, I think, a good educational value point, is that the market had been testing this key trend line for 1, 2, 3, 4, 5, 6, and a 7th test. And right before that 7th test, we shorted the market through a leveraged short ETF that we sent an alert on a few days ago, a few days on Monday, on Monday on the website. And the reason for that, a lot of people think, hey, this support level has been tested many times, and so it's bound to hold. But that's not how things actually work. A support level acts as an area of demand, right? So buyers are stepping in every time that price is testing that support. Ideally, you want the price to test the support and bounce right off of it and move away from it and continue accelerating higher. And that's what happened in early August. It's what happened in September here. But as you can see, since October, we started to see multiple tests here. So that's telling us that sellers are coming in every single time to quickly push the market back down to that support. And there's every time buyers are stepping in, but that means there's less and less buyers to actually hold that support. So on the 7th test, typically on the 7th test, I would say there's a high likelihood of that support actually breaking, and we can actually short the market before that breakdown occurs. This is one of the things that we're going to talk about more extensively on the curriculum, but it's one of the ways that you can have an edge on the market before other people actually step into a trade and get a good price on a potential short, or even that works the other way around as well. So that's where we are. We have the breakdown, technical breakdown, and this is coming off, yes, a very strong rally that's fundamentally backed by a strong macro environment, but also high levels of overextension. So we're not looking here to be buying the dip straight away. There could be more pain, and one of the things that we were discussing just before this live is the nature of this sell-off. You can see, let's go on the daily chart here, and you can see that the sell-off since late October has really been very steady. You can see that, right? It's been very controlled. And some people might say, okay, it means there's not a lot of selling pressure, but actually, it probably means there's room for selling pressure to expand. And to me, it looks a lot more like the behavior that we had here in February and March of 25, a controlled sell-off, rather than a panic that can often lead to a local bottom. And that's one of the things that typically happens at bottoms. Is you see a panic, you see a capitulation, and even very short-term bottoms, right? Even shallow corrections often have that type of panic. It's one of the reasons for why, following Donald Trump's tweet here on the 10th of October, we had a very powerful sell-off. But volatility spiked a lot following that tweet during this correction. We saw that as a reason to actually expect the market to resolve higher. What we've seen here is rather a much more gradual rise in volatility that could get steeper, right? Now, one thing that's and by the way, I'm just drawing this out randomly. I don't, we're going to talk about how deep we should expect this pullback to go. We don't think this is a repeat of what happened earlier this year, but more pain to go. That's definitely not out of the question. You can see home builders is one of the big things that we watch to confirm or invalidate a move on the market. Home builders, by the way, again, something that we'll talk about extensively on the curriculum, because this is a huge way for us to gain additional insight regarding what the market is going to do next, what should be our bias on the market, how we should be allocating to stocks, right? And it's playing out beautifully yet again today. Home builders are a leading economic indicator. They look forward, and they are extremely useful to understand what the behavior of the consumer is, right? Housing activity is one of the most fundamental sectors of the economy, and when you have a thriving housing market, it means consumers are going out, buying homes, homes are being built, and the earnings of these companies are thriving, and that's a signal that the economy is that the, let's say, rates are low enough for housing and the economy to thrive. What we're seeing today is that despite the Fed having cut rates since 2024 multiple times, we're still seeing weakness in the housing sector, right? That it would be a whole different story if home builders were thriving here. We would probably not be expecting even additional downside right now, because the fact that if home builders were melting up, that would be a really, really strong sign that we're seeing a thriving economy right here, right now. We're seeing the opposite. We're seeing them break down. The most recent technical breakdown on the S&P 500 was accompanied by a further breakdown on the home building sector that's also slicing through key moving averages. So not great. Now, by the way, and this is one of the reasons why we're keeping our short on the S&P 500. We haven't trimmed it yet. And we want to leave this trade a little bit more room to run because of that confirmation. Now, I do want to put a little bit of nuance, and this is very, very important, because I think a lot of people approach trading, especially at the beginning, with a mindset of, okay, this is what's going to happen. This is the prediction, and this is set in stone. Unfortunately, that's not how trading works. You have to adapt. You have to be flexible. You have to understand the setup that's in front of you, and you have to understand that that setup can change, and you have to change if the setup changes. You can't be married to a view on the market. Now, there's going to be the FOMC meeting minutes released today. NVIDIA earnings are being released. Unemployment numbers are being released this week as well. So there's lots of things that could perhaps shift the way the market sees the strength of the economy in the short term. And perhaps tomorrow we'll see the market jump like this, with home builders making a 180-degree turn. If we see that, we'll have to adapt. We may need to cut our short. We'll stop it out as if we see things change. But for now, even if the market moves a little bit higher, as long as those things, the weakness in home building, we're also seeing weakness in small caps. We're seeing the internal breadth of the market deteriorate. As long as all of these things are intact, even a bounce in the market would probably be an opportunity. Would definitely not be something that we use to cut out our short, unless, of course, it slices through our stop loss that's roughly above this trend line that you see right here. So yeah, that's the way we're thinking about the market. And again, the key point here is understanding that there was a setup, and there is still a setup to be short on the market with a limited amount of risk, right? We know where we are wrong. We know that if price comes in, slices above this trend line, we should be out of that short. But as long as the price keeps on slicing through key levels and breadth remains weak, and until we have seen that real type of capitulation move, we can hold on to that short and just lower our stop loss along the way and stay short on the market. And we're going to talk about our other positions, the other positions that we have on the market. As Nick mentioned, we have some healthcare and biotech stocks that we're holding on to because they're being very strong, and that's not something that we want to be missing out on, because again, generally, this is a short-term correction. During short-term corrections, you don't want to be just going all in on shorts on the market. You still want to be watching for relative strength in certain parts of the market. You want to still be scanning for setups that are looking good. It's not like 2022, March of 2022, where regardless of what you were looking at, pretty much all sectors of the stock market were moving down during that period. And so, you were cash or perhaps in alternative assets. Gold had a couple of good trades here, being short on bonds. The energy sector was a good trade during this period. So you just because we're bearish on the market doesn't mean we're going to be dumping all of our positions and going 100% cash and short on the market. So that's something that's important to understand. And one thing that is really was eye-opening for me is how much not only, first of all, getting defensive when things are starting to shift, things are starting to look less favorable. Maybe the index is still moving higher, but underneath the surface, you're starting to see these warning signs. You're starting to see these setups fail, and you want to be getting defensive. You want to be listening to what the market is telling you and not chasing these last couple of gains on those last few runs on tech stocks. Maybe Nvidia, Nvidia made a new all-time high here, but it's a risk to be chasing that this late into a rally. And then on the flip side, being fully aware that a correction can turn around on a dime, and that you want to be ready. You want to have the setups on your watch list that are ready, and the breakout levels ready, and you want to be, as soon as things change, you want to be back in the market and riding the next leg higher. Right now, that's not the case. So why do we not believe that this is going to be a massive correction? Let's quickly talk about that. Real GDP growth, I think, is a good place to start. Real GDP growth is at 2% right now. 2%. This is roughly the place where you see stable economic activity. And let me add the S&P 500. This is the type of environment where you see the bull markets occur. You tend to see stocks rise, even if not everybody agrees with it. The fact of the matter, stable economic growth means the economy is still expanding. It means Wall Street can still get more and more optimistic on their earnings estimates. It means that valuations can continue rising. So all of that is pretty constructive. As long as you have a stable bond market, stable economic growth is pretty good, right? So GDP growth is strong. And one of the things that we also have, and we can put up that chart of GDP now growth to showcase where GDP growth is right now. There's a model from the Atlanta Fed that I can add that to the screen. Yeah, this model from the Atlanta Fed that shows what GDP is today. Right, so this is very useful because it shows us. It shows one of the problems by looking at the government numbers is that you get them on a monthly basis and they're lagged, right? So that's not very useful. You're basically playing with outdated numbers. You're not looking at what's happening today. With GDP now estimates, that's very valuable because we're looking at the at least according to the Fed's estimates, what GDP is today. And the truth of the matter is GDP is at 4% as of today and has been hovering around 3 to 4% since July till present day. Now, you could argue a lot of that is being driven just by semiconductors and data centers. And there was this estimate from a Harvard economist that GDP growth was essentially zero without growth from data centers, but stocks the data centers participate to the growth of the stock market. So in regards to stocks, we're not trading the economy, we're trading stocks. Remember that. That's those are the numbers. And yes, AI is participating to that. And yes, you can question how long lasting that theme is going to be, and what's going to happen when the Fed starts raising interest rates again, right? If that bubble is going to pop, probably it's going to pop, and probably it's going to be painful. But for now, that's not the case. And that brings me very nicely to what are the big risks to GDP growth, right? What are the two big risks to the economy not growing anymore? And if I have to really summarize it in the most simple way, and I think as traders, it's very important to keep things extremely simple, right? Economists can go all over the place on their quantitative work and their complex analysis, and 90% of the time they don't get their estimates right. As traders, we want to be right, and for that we need to keep things simple, and we want to be flexible and know when we're wrong about something, when things are changing, and for that things need to be simple. We can't have extremely complex models that are influencing every day how we should be interpreting the economy. And so the two big things that are influencing GDP at all times are A, the Fed. So let's put up the Fed funds rate here. Let me show my chart of the Fed funds rate, and let me put on the recession bars. This is a chart that I think a lot of people have already seen. This is the Federal Reserve's interest rate, the Federal Reserve being the US central bank, the most powerful institution in the world, right? They control the price of money. You cannot underestimate how powerful the Fed is in regards to controlling the economy and financial markets. So pay attention to what the Fed is doing. Don't fight the Fed is true, right? Whether you like it or not, it's true. And when the Fed raises rates, when they raise rates aggressively, often you see a recession, right? You can see these recession bars from the NBER follow almost systematically periods where the Fed has raised interest rates or shortly afterwards. There's very little exceptions. The only exception in the recent past was 2020, where the Fed had been indeed cutting interest rates since January 2019, and of course COVID came and that triggered the recession. So yes, a pandemic can trigger a recession, of course. But right now, there's no pandemic, and the Fed is cutting interest rates. So the most powerful institution in the world is lowering the price of money. That is something that is at least not going to negatively impact GDP growth in the short term. We typically say that the monetary policy has a lagged impact of roughly 14 months on average, 14 months. For the last 14 months, the Fed has been cutting rates, right? So that's very clear. The other big thing that influences economic growth is inflation. And here we're going to show a very interesting chart of inflation, of how inflation actually leads real GDP growth. So if I can add the chart of real GDP inflation leading GDP growth, perhaps I can create it. Oh yeah, there it is. So this red line here is the inflation rate that has been inverted, and it's also been shifted forward by 6 to 12 months. And the blue line, if you recognize it, is the real GDP growth of the United States. And this is not a chart that I've seen anywhere out there. This is one of the things that we've talked about for a while now, and I think it's a very original way of looking at what really influences GDP growth. And you can see that inflation leads the real growth of the economy by 6 to 12 months. And it makes sense, right? As the cost of living goes up, right? That immediately impacts the way people feel about their financial situation, the way they spend. And so it impacts economic growth, it impacts consumer spending. And so every time that you see a spike in inflation, around a year later, you see a drop in real GDP. And every time you see inflation fall, a year later, you see generally inflation, you generally see real GDP go up. And so right now, inflation is relatively stable. You could argue that we've had a little bit of a bump more recently as a result as a result of tariffs that have brought up the inflation rate to 3%. Let's come back to the inflation chart if I can remove that. Yes, coming back to the inflation chart. Yes, inflation has been coming up a little bit, but generally, and this is what's a little bit rigged about the system that we're in, and what's contributing to rising inequalities, thriving corporate America, and unfortunately not a thriving real economy, is that the fact that the real economy is not thriving, the fact that the consumer is generally not extremely strong, that the savings rate is low, that consumer confidence is low, that the housing affordability is low, that people are being squeezed. That's all contributing to this low inflation, right? And so we have every reason to suspect that that inflation is going to continue dropping lower because of that fundamentally weak economy. That the baseline inflation rate is very low. We're not in an inflation in an environment like the 1970s where people are thriving. There's high wage growth. People are bidding up their salaries because the labor market is because there's huge growth in the workforce and high velocity of money. Today, it's just the opposite. We have a fundamentally weak economy that's contributing to fundamentally low inflation, and so that's helping keep the Fed lowering interest rates. It's helping kind of keep this environment of relatively stable real growth, where people are not going underneath the surface, but they're still spending, and that's helping tech stocks, large companies moving higher. And that's one of the reasons for why, if we come back to the S&P 500, one of the big themes that we've had since 2022 is tech stocks moving higher. That's the first thing, right? Let's look at the percentage gain of tech stocks against the rest of the market. Tech stocks have been outperforming. So if we expect that this type of environment is going to continue, we should expect the same leaders. And that's what we talked about earlier, is the fact that we should continue essentially these same companies. And more recently, it's been AI that's been thriving from this environment. There's a good chance that coming out of this correction, tech is going to continue outperforming. So we have a list of stocks that are in the tech sector that we're going to take a look at in just a second, that we think are big opportunities coming out of this correction. Again, if we see the right things, if we see the stars align, the stocks that we're going to take a look at in just a second are big trades that we think could yield returns. Before we do that, I know there's a lot of people that have joined since we started this, so I do want to do a quick reminder of the offer that we're doing, and that's not going to last very long. So let me show that once more. Sorry, how do I show the offer. 1 second. Yes, we're gonna show the offer in just a second, but it's essentially the 1 second. Having a little bit of technical issues here. Perhaps Nick, if you're able to show the website.
Yeah, 1 second.
Doesn't seem I'm able to on my end. All right, yeah. So yeah, we're doing just for Black Friday, and the 60% off is just for this live, a bundle of our biggest services, including the curriculum that we talked about throughout the beginning of the session, where we're going to share everything that we know about trading, about markets, about how to navigate markets, how to generate returns, right? And the reason I'm saying this here before looking at the trades is the types of trades that we look for offer typically 20 to 30% returns quite quickly, right? Versus a 5 to 10% loss also quite quickly. We want to know when we're wrong very, very quickly. And one of the things that we do is we try to rotate as quickly as possible through those trades, getting that 20 to 30% return again and again, or that 5% loss. And if we're able to even get half of our bets right, that can lead to significant returns, right? That's how you hit those 50% a year returns. And if you build the skill to be disciplined and methodical on how to watch for those trades and systematically be able to take advantage of them, that can set you on a path to success in trading. So that's what we're going to be covering in the curriculum. And it's also the types of trades that we that are included in the Bravos membership, the trading membership that we do, and something that we also include in the training session. So again, only an offer that's going to be available during this live, so make sure to take advantage of it. If this is something that you guys are interested in, we're going to answer more questions on this later in this live session. But before we do that, let's get into the trades. And I can share my screen again on the S&P 500, but take a look at the first trade. That is TSMC. So wrong TSMC. TSMC here is a semiconductor stock that has, of course, benefited from AI throughout this entire bull market since 2022. It's been one of the strongest performing stocks. It's the main semiconductor manufacturing stock, and it's had its earnings absolutely boom during this period, right? Its profit margins soar, and you can see from a technical standpoint, this is an extremely strong setup. We have a basing pattern that formed starting from January of 25, all the way till September of 25, right here, that broke out. And now during this correction, this is, by the way, not a guard. I mean, it might look like a small correction, but this is a 12% correction so far in TSMCs that we're very happy to sidestep. But overall, technicals look fantastic. It's coming in to test its 100-day moving average. And if things turn around on the S&P 500, this is a stock that we're looking to ride for the next leg higher, right? TSMC, very, very nice move. And in terms of the target, this even has a much larger target than what we usually do. The three stocks that I'm going to cover here are larger opportunities in the market. So they do have larger targets. Not all of our trades have these kinds of target, but this is a 70% move potentially from the break of the trend line. And of course, this would that would lead to potentially a $300 price target for TSMC, right? And that of course assumes that you're heading into some kind of a euphoric move in the tech sector. That no, this was not the top. That yes, we are still in a fundamentally interesting environment to own tech stocks, and that they have further room to get more crazy. So TSMC would be one of those candidates for that. Amazon is another one. Now, Amazon's getting absolutely wrecked in this correction. So again, we're happy to sidestep that. But from a fundamental standpoint, Amazon is very, very interesting, right? This is a stock that has since 2021 here, it has quadrupled its earnings. It has quadrupled its earnings since 2021. So, and look at the price where it is. It's up 30%. So there's room if we get back into the same type of euphoria that we were in the market in 2021, and a lot of the sectors of the market are at similar valuations on a forward PE ratio, which is a good measure of valuations based on future expected earnings. There's a case to be made that there's a lot of upside on Amazon, right? So that's one aspect of it. Also, in the near term, it's been ramping up its earnings since December, and it's around the same level it was in December of 2024 right now. Since then, it has increased its earnings by 50%. Or 30%. I don't remember exactly the right number, but 30 to 50% when the price action is essentially flat. So there is room for the market to get excited about this stock. And right before this market correction, the stock actually broke out, but it's been pulled down by the gravity of the market correction that we're currently witnessing. It's testing its moving averages. It's going to be interesting to see what happens, but our instinct here is to say that, of course, depending on the market, it's going to chop around a little bit and then begin to take another jab at a breakout and head to some potentially much higher targets in the next phase of this run. Of course, keep in mind, yes, this is a stock that we're watching very closely, and so. If you want signals on these stocks, Amazon, TSMC, and you want to know exactly when we're entering, that's also included in the bundle that we talked about earlier. Finally, the last stock that we're looking at is New Holdings. New Holdings is a fintech company, emerging market fintech company, high growth. So extreme revenue growth over the last few years, profit margins expanding significantly, so strong fundamental setup, and also what's called a PEG ratio of 0.8. Now, the PEG ratio, for those of you who don't know, something we look at and something, again, that we'll cover in the curriculum, but the PEG ratio is how much you are paying, how much investors are paying for per unit of growth. And this is, quite often growth stocks are highly overvalued, and that's also reflected in a high PEG ratio where investors are essentially overpaying for the growth of the company, right? People often say, okay, yeah, I'm overpaying, yes, but this company is growing very, very quickly. But what's the PEG ratio, right? If the PEG ratio is above 1, that tends to be overvalued. Below 1 tends to be undervalued. That's a typical textbook definition of how to read the PEG ratio. New Holdings is currently at 0.8, which does make it one of the more interesting high growth companies coming out of unprofitability. This was a company that was unprofitable in 2022. It's coming out into profitability. quite often, this is when Wall Street gets very, very excited about growth prospects and starts to look for a higher PEG ratio. On top of that, you have the technicals that look quite incredible. It's hovering right below all-time highs, making this kind of basing pattern, waiting for the market to give it a green flag to break out. Right, I would expect this to be a very, very strong performer when the market resolves higher. On top of that, you have this basing pattern right here that broke out earlier, and it's so far been just consolidating, allowing the moving averages to catch up very nicely here. So great fundamental and technical setup.
And just to reiterate that, of course, we want to focus on stocks with strong fundamentals, and we want them to be in sectors that have a solid macro tailwind behind them, because that absolutely matters. But at the end of the day, the number one thing that we care about before entering any trade is the technicals. We need the technicals to line up before we, initiate a trade. We need the risk to reward to be worth it in order for us to execute. So even though we're highlighting these names because they have great fundamentals and a lot of potential and great narratives behind them, the real goal is simply just to be keeping them on your radar and waiting for the chart to give you a clean setup. We want to wait for, the risk reward to make sense, and that entry where the structure is tight and you can define your risk clearly. So that's what ultimately drives our decisions. The fundamentals help tell us what to watch. The macro tailwinds kind of point us in the right direction, but the technicals tell us when to act, and that timing is everything.
Yeah, absolutely. The all of the things, the fundamentals, the macro, intermarket internals, all of that helps. It helps for understanding your cash allocation and how much exposure you should have to stocks. But in terms of particular trades, it helps you, just as Nick pointed out, increase your win rate, increase your potential price, your risk reward, right? For you to be able to spot trades that have a huge upside because of that fundamental runway. That's what these edges, we call them, are for. But edges are useless without the set of precise rules from a technical and price action standpoint that help you guide you in your day-to-day decisions on your trade. So that's indeed a very important part of at least our trading style. There's not everybody trades like this, but that's what has made us successful in markets, and that's what made a lot of people very successful in markets is having that disciplined, price-oriented approach, even if there's other things coming in to increase your conviction level or that sort of thing. So let's move to Bitcoin, that I think a lot of people are interested in knowing more about. So Bitcoin is of course declining, but and is down quite substantially since its peak. 30%, almost 30% drop since its peak. So before we look at that, let me show you let's zoom out a little bit and understand what the fundamental picture is on Bitcoin. This is the Bitcoin to gold ratio. And remember, Bitcoin is supposed to be digital gold, right? And in gold terms, Bitcoin is supposed to be digital gold, and so it's supposed to be displacing the market cap of gold, something that it's not doing right now. It's falling in gold terms. In fact, it's not really been doing that since January of 21. Right, it's flat since January of 2021, and it's even, you could argue, it's not been that strong since December of 2017. So it's not really been displacing gold in a big way. Now, we happen to think that it will. Right now, a lot of people don't agree with that. A lot of people believe Bitcoin is heading to zero. We do see that there's a use case in terms of Bitcoin being digital value, the fact that you can transact large sums of money without a third party from one corner of the world to the other in almost immediately with no fees. That's a use case, and that's more useful than gold, right? In terms of keeping value stored and freely available and extremely extremely mobile, right? That is, especially in today's world that's becoming increasingly uncertain from a geopolitical standpoint, that is a real use case, right? And there are reasons to believe that digital gold is going to gain share relative to gold, usual gold, right? Physical gold. It's not happening right now, and a lot of people are very, very surprised by that. That with all of with gold melting up, with all of the talk about currency debasement, the debt pile, and incoming government spending, and even geopolitical uncertainty, you would expect Bitcoin to be serving as a hedge, but it's not really yet a debasement hedge. It's still a young asset that is still being treated by financial markets as a risk-on asset. So let me add the S&P 500 to gold ratio here, and you can see that it's basically just doing the same thing that the S&P 500 to gold ratio is doing. So it's trading a lot more, and this is something that we already knew, that we observed during the bear market in 2022. We know that Bitcoin trades like a risk-on asset, and the truth of the matter is, since March of 2024, which is really February 2024, which is really the moment where stocks peaked relative to gold, it's been overall a risk-off environment. For risk assets, stocks have underperformed gold, and if you look at it through that lens, Bitcoin hasn't actually done too bad because since then it's been pretty much flat, right? And since 2021, let's take that peak in 2021. Yes, Bitcoin is down since November 2021, but look at stocks to gold. Right, so this has been overall a macro environment that's been more risk off than anything else, and it's hard to understand that when you're just looking at the nominal price action. When you're just looking at the S&P 500, you're seeing it melt up. Hey, why is Bitcoin not melting up? Well, because first of all, it already did melt up between 2022 and 23, but also we're not necessarily in a super risk-on macro environment today, which is why we're seeing selling pressure build on Bitcoin. Now, from an investment standpoint, we think this is interesting, right? Bitcoin is coming in to test some levels of support. Could it go lower? Could it test the bottom of this channel? Of course, right? But from an investment standpoint, I definitely like this a lot better than Bitcoin looked relative to gold here, right? And you could very much argue, and this is actually something that we expect, that in the next risk-on phase, right? And it's not yet the case, but in the next risk-on phase, you could see this pattern break out, and that could lead to a significant outperformance of Bitcoin relative to gold, in the same way that you saw a significant outperformance of Bitcoin relative to gold following this breakout that I'm sketching very loosely here in November of 2020. So this is something that's very much within the cards for Bitcoin, but in the short term, this is one of the fundamental things that we also cover. We will also cover in the curriculum is understanding the difference between your investing and your trading, right? And one of the things that we recommend to our mentorship clients is that they actively separate their investment from their trading portfolios to understand, because these two require very, very different approaches. And if you're confusing the two, that is, in my experience, from what I've seen, is the single biggest mistake that leads to massive losses. Switching, not understanding, and kind of having a very vague interpretation of what investing is and what trading is. That's a killer, right? And so that's definitely not a mistake that we want to make with Bitcoin. If you have an investment portfolio where you want to invest for long term, Bitcoin at all times is interesting to us, is an interesting investment. Today, it's quite interesting buying the dip on this correction, especially in gold terms. It's very interesting. From a trading standpoint, that's a whole different story, and I'll let Nick dive into the technicals on Bitcoin right here.
Yeah. So on a daily chart, what we're seeing right now, as we all know, is a clear technical breakdown. So we're seeing the longer term moving averages starting to curl down, and you have price kind of sitting below them. And the overall structure is shifting into something that looks a little bit more bearish. Now, does that automatically mean that Bitcoin has to keep falling from here? Obviously, not necessarily. And I mean, in the short term, if you're looking at certain things like the RSI or the distance between the price and the moving averages, we are a little bit overextended to the downside, and it wouldn't be surprising to see some sort of short-term bounce to go and retest maybe some of the levels of support that we've had in the past. But as of right now, that would only be necessary, more of like a relief rally or some sort of snapback until a bigger base is formed. So the real context here is from a trading perspective. This is a spot where we'd prefer to take more of a wait and see approach. We don't want to be trying to catch a falling knife, and we don't want to be forcing a trade when the structure doesn't necessarily support it. So what we're looking for is something along the lines of what Bitcoin did back in early 2025, or even the basing structure that it built throughout 2024, where we see price start to cool off and stabilize. We see it form a base. We see the price starting to tighten up, and then break out over its resistance and start building price action above rising moving averages. Like that's the type of environment where not only do we have the macro tailwinds behind us, but we also have technical support at our backs, and that's when the risk to reward of a trade starts to work in our favor again. So right now, what we're waiting to see is the support, present itself before we re-enter. But with regards to price, it wouldn't be surprising to see price fall towards that $80,000 support level. And even at that support, it wouldn't be surprising to see a liquidation, as Bitcoin typically does, before ultimately building that base and resolving higher. So the bottom line is we're not bearish for the sake of bearish on Bitcoin. In fact, for the long term, we do think that Bitcoin presents a great bullish case. But in terms of trading, we're simply waiting for the chart to develop a setup that fully aligns with our trading strategy.
Yeah, absolutely. Absolutely. I mean, you said it. We learned this the hard way. I should say is trying to fight a trend that's there, trying to time the bottom just because you're seeing, yes, the RSI is overextended. Maybe it could bounce, maybe not. Until you have a setup, until you have price confirmation, where you can have a clear understanding of what your reward is on that trade versus what your risk is. And when we see that on Bitcoin, as soon as we see that, we're going to be trading it, right? We're going to be sending buy entry at Bravos Research to highlight that we're entering Bitcoin and potentially riding it for a much larger move, depending on how risk on things get, but potentially riding it for a much larger move. And again, before we dive into gold to silver, for those of you who have joined the live since the beginning, we are doing a Black Friday offer that's only going to last during this live, a 60% discount on our biggest services, including all of our trades, like a potential trade on Bitcoin that we're going to do when things get constructive. That's included in the bundle, along with pretty much all of the education that we're going to be providing over the next over the lifetime of Bravos Research. So this is probably the best deal that we're ever going to do. So you can click the link down below to if you're interested in that. Okay, let's take a look at gold and silver because I think this is a very interesting part of the market that's quite controversial. Just for some context, I mean, obviously gold has been thriving and melting up in recent months and breaking out above a massive secular bull market pattern here. Huge breakout in early 2024, major melt up following that breakout, very intense bullish price action, and huge fundamental driving forces behind this. High uncertainty geopolitically, internally. There's outflows from the treasury market that's becoming, it's increasingly clear that treasuries are not going to be an interesting investment long term, that deficit spending is going to continue, that rates are probably going to be lower than inflation in order to stimulate economic growth. That's going to drop. And central bank accumulation as a result of that uncertainty. So all of those things, cocktail pushing gold into a melt up. And by the way, this is something that I am proud to say that we have been taking advantage of that since 2022. We've been taking advantage of this entire run through gold, leveraged bets on gold miners, and silver. Many trades that you can check out all of our close trades on our homepage if you're interested. But we have a long list of gold trades, but right now things are perhaps starting to change a little bit for the first time, and people are not very happy when we start to talk bad things about gold, especially given that this is an asset that we've loved. But look at the RSI on the monthly chart. This is the RSI is an indicator that gives you, it's a momentum indicator that gives you a sense for how overextended, how overbought, or how oversold price action is. It doesn't predict anything, but it tells you how intense a rally or a sell-off has been. And here we've seen on the monthly chart, the RSI hit 91.64 here, which is one of the highest levels ever, comparable to the peak right here in 1980, the peak here in 1973. Now, I don't think there's secular forces at play here, which I think are going to last longer than a few years, and are going to continue pushing stocks, gold higher over the coming years. But in the near term, an overextended reading like this is a little bit concerning to us as traders. And you can see here, there's two examples of gold being in a secular bull market with levels of overextension like this in 2006 and in 2008. And both of these, it might not look like large consolidations, but both of these did lead to some pretty lengthy periods of consolidation and even pullbacks on gold. So it's entirely possible that, and again, it would probably need some kind of a catalyst for consolidation to really start on gold. It's possible we've already started it, but the odds of this happening are increasing as gold rises, right? And so this is one of our big trading rules. And we do have a set of trading rules that we don't like overextension because it reduces our runway. It reduces the runway for the trade to appreciate. Here on the breakout in early 24, we had a massive runway for gold to rise. We were extremely confident in initiating trades on gold because there was this long-term breakout and there was plenty of runway. Gold was not overextended. Gold miners were extremely cheap at the time. And so there was plenty of runway. Today, it's actually quite different. There's definitely a lot less runway. Now, there is some good news in all this, that silver could still be an opportunity, at least for a trade. And let me add silver here. Let's put this on a weekly chart so you can see more clearly. You can see silver tends to have these types of melt up moves. It tends to melt up. Let me put this on a log scale. It tends to melt up like this towards the end of precious metal rallies. So towards the end of 2003, 2004 rally, towards the end of the 2006 rally, towards the end of the 2008 rally. Every time towards the end, you had a melt up on silver. Again, in 2011, big melt up on silver. So what often happens is you have a euphoric move on gold, and you perhaps see some profit taking from gold happen, and that gets rotated into silver. That's a lot more volatile and that has a smaller market cap, and that silver kind of benefits from that inflow of capital and melts up. And that's something that's happened a lot throughout history. That could be a trade here. And you sometimes even have gold peak before silver. That happened in 2004. Gold peaked right here in January. Silver peaked in March. And between gold's peak and silver's peak, silver had jumped by 30%. Right. So is it possible, and this is not a prediction, but we're highlighting a potential scenario. Is it possible that gold has already peaked and that we're still due for a silver melt up? I think the odds of that are definitely non-negligible. And let me highlight the gold to silver ratio that I think is very relevant today. The gold to silver ratio is, of course, the performance of gold to silver. So when the gold to silver ratio drops, it's a sign that silver is outperforming. And when the gold to silver ratio is moving up, it's a sign that gold is outperforming. And you can see the gold to silver ratio right now is beginning to break lower, right? It's breaking down below a price trend line that dates back to March of 2021. Let's take a look at the previous moments where that happened. July of 2020, April of 2016, August of 2010, December 2003. If you look at the price of silver in each of these, what followed was a huge price appreciation on silver, right? So very, very interesting setup here. If the gold to silver ratio were to actually break down, which it is attempting to do so. It hasn't really done so yet, but it's attempting to do so. And what's very interesting is the fact that it's attempting to do so during a market correction, because silver is a risk-on asset, and so it's waiting to see what the market does before breaking down. And if you want to jump in here, Nick.
Yeah, absolutely. So and you just alluded to the point that I was going to make, that not only does a breakdown in the gold to silver ratio indicate a potential trade on silver, but because it's a broader indication of risk on, it can mean that a lot of the trades that have been working throughout this rally could continue, and you can see a lot of rotation back into the higher beta names where you've seen risk on moves appreciate the most. So I think the signal, if it does break significantly, could be a twofold trade signal. Oh, Peter, I do not know where. There you go. Sorry.
Yep. Can you hear me?
Yes. Yeah, you're good.
Yeah, the gold to silver ratio is immensely valuable, not only for to understand what you should be favoring, gold or silver, but also the stock market. You can see that breakdowns in the gold to silver ratio tend to coincide with the beginning of at least short-term periods of market outperformance, so risk-on environments. So if we're seeing this correction continue, one of the things that we'll be watching out for on a bounce is if the gold silver ratio is breaking down. If it's breaking down, as Nick said, that's a bullish signal for stocks and for silver. So yes, I think that's all we wanted to cover in terms of the market price action. The goal of this live was to give you an update on the market and some of the key opportunities. Hopefully, we've been able to do that and showcase our real trading style. That's not something that we typically do in the YouTube videos that we usually post. So this live hopefully gives you a glimpse of the value that you guys can get if you're subscribing to our service, if you're taking advantage of the offer that we're doing during this live. Click the link down below if you're interested. Yeah, I think we're going to do the Q&A now. If you guys have any questions on the bundle, the service, the curriculum that we're offering, we're here to answer anything that is on your minds. And we'll be joined by my co-founder, Edward.
Yeah. Hi, everyone. Thanks Peter and Nick for the live stream. This is great. Yeah, some great questions on the live. Basically, I think Peter, one of the recurring questions, I know that you covered it a couple of times, is what do we get? I think a lot of people coming in and out of the live, but if you could perhaps go over again, what do we actually get with the live and the curriculum and the Year of Signals? Yeah.
Yeah, absolutely. So in terms, one of the things that we didn't highlight in terms of the weekly training sessions is those are essentially educational sessions that we're doing every week, where we're going to be catering to typical questions, the most frequently asked and pertinent questions that traders might have during their journey to improve their trading style, to try and understand how to adapt their trading style, understand our trading style and how to incorporate it into their own analysis, and of course, questions on the market as well. But yeah, so that's the weekly trading sessions, and though that's going to be a full year of the of training sessions that you're going to get. When it comes to the curriculum, the lifetime access to the curriculum, I do want to be very clear on this. We've started it, and there's a few episodes that have already been complete and that are already in the pipeline to be sent. But it's not complete. This is something that we're working on every week. We're going to be sending out episodes bit by bit, and the goal is over the next few months to build a full curriculum of everything we know about trading. As I mentioned earlier, how we select trades, how we manage them, how we select them, how we screen them, how we choose which one is the best, how we choose our different allocations, how we manage the trades from A to Z, from the entry to managing the setting the stop loss, pushing the changing the stop loss as the trade progresses, where to book profits, how to book profits, and how to have a very systematic approach to doing that. And then finally, the allocation aspect of the market, and how to read the market, the macro environment, how we do that, and how to translate that information into actual percentage allocation, how to get defensive, what types of warning signals you want to be looking out for to get defensive and to get to increase your cash allocation, to get to build up dry powder, and also, of course, when to get more aggressive, what types of signals and what to weigh in when expecting a balance and a resumption of the trends. So that's the curriculum, and we're going to be building that over the next few months. And finally, the Bravos membership, the macro membership, is essentially all of the trades that we do. This is the membership that we've been building over the last few years. We've tailored it to make it the most applicable to somebody who's joining the service and who has no idea how things work. We have a dashboard of all of our current trades, right? And we have our allocations for each trade. And of course, we have signals for when we enter a trade, when we're booking profits, when we're making any decision. And on top of that, we have multiple videos throughout the week where we're explaining our strategy, explaining how, whether we're getting aggressive, defensive, what trades are on our watch lists, what we're looking for in terms of opportunities, in somewhat of a similar way to what we did during this live.
Yeah, thank you for that, Peter. I think one of the questions that I saw recurring, and I think that there's a few clients from the service that we have, is this offer the same as the mentorship program? And I think that should be coming from a client, because the mentorship service and program is not a public offering that we have.
Yeah.
For context, the mentorship is a service that we have for very select clients, where we provide very hands-on, one-on-one guidance, essentially to help traders become consistently profitable in markets, and teach them the discipline to apply their edge in our system. Nick works directly with a lot of these clients, Peter as well. And the mentorship is not this offering is not the mentorship, but there is some similarity. You do have access to the course curriculum, which is one of the offerings from the mentorship. We do also cover the weekly live training sessions, which is part of the mentorship. So you get most of the content and most of the knowledge from the mentorship with this bundle. You get essentially access to all the service that we can provide, except the mentorship. So I hope that makes sense for clients. Another question that I saw in the comments is whether this is one time or recurring. So this is one time. This bundle covers 3 different services. As Peter said, the curriculum is a lifetime access. So you get lifetime access to that educational library. And then you have 2 services which are on an annual plan, which are included in this Black Friday offering, and that's the weekly webinars, and that's the year of Bravos membership, where we provide video breakdowns, daily trade alerts, and you have access to all all our trading and live trading directly from our accounts. So yeah, this is really a one-time offering. This will not renew, and you get access to the curriculum for life. Another great question I just saw you guys is, and I see that there's a lot of clients on the live stream here. Can current clients benefit from this? Yes. The upgrades might not be clear as it should be, as I see a number of questions here. But if you're signed in as a client and you open the page that we've linked here on the comments or the description, you should be able to upgrade and get access to the curriculum and the weekly training sessions. If you're logged in as a client, the bundle will be different. It will not include the macro membership because you're already a client. So what happens to your subscription? It will just be the price will be adjusted, and you will have an addition of the curriculum and the weekly training sessions on top of your membership. So if you have any issues, please just shoot us an email. We'll make sure to reach out directly. If you click the link, that you should be having no issues with the access. Yeah, I think another question that yeah, go ahead, Peter.
No, go ahead if you had another question you saw.
Yeah, I think some great questions, but I just noted the most important ones. Question I saw a couple of times: if you purchase now to lock in this discount, can you activate later when you have more time to dedicate to the signals? Yes, you can do that. If you purchase, you can lock in the Black Friday price, and just email us when you would like to put your membership on hold, and when you would like to activate your membership. So we can be flexible with locking in this launch price.
Okay. Yeah, and just a reminder, this is indeed a pricing that's only going to be available to this live. So I do want to say thank you to each and everyone who have been on this live with us. Hopefully we provided a lot of value to you guys. That's our goal here, and so as a gift, we are doing this additional deeper discount on this. So we'll leave the discount on for, I believe, another hour or so. But yeah, don't miss it. Yes. Okay. I think this was a great session.
All right. Well, awesome. Thank you for everyone for being here, participating, and we'll see you next time.
Yes.
Yeah. Thank you, guys. Thank you, everyone, for joining. Appreciate that.
Thank you. Bye.